Okay, Adam, I'm making you the presenter. Looking forward to seeing your screen and hearing your voice and learning about how you deal with and interpret the COT.
Yeah, can you hear me?
I can. How are you today, buddy?
I'm pretty good. How about you?
Good. It's very nice to meet you, and I want to thank you for taking time out today out of this somewhat busy session to address us. And I know that you want to talk about COT. I'm always interested, though, Adam, on what was your foray into the business? How did you get started? Where were you at point A? Now you're at point B. How did it happen for you?
Yeah, so for me, when I went to college my freshman year, I got really interested in trading and investing. And so I read a bunch of books because at that point, your freshman year, you're not taking anything really super specific to your major. So I was reading a lot freshman, sophomore year. And then after my sophomore year, one thing I was sort of concerned about is, I had all these friends and we were in all these different degree paths, and we didn't really know what that
you were going to do.
Like. Yeah. Well, not necessarily that, but like, for example, I was a finance undergrad, but I didn't know if I actually wanted, the day-to-day life of somebody in that industry. And so between sophomore and junior year, I took off and I worked for a year at a hedge fund local to me. And they were sort of more of a CTA, like a commodity trading advisor. And it was a good role because it was.
Are you from Chicago?
No, I'm from the deep South, Mississippi.
Oh, okay. All right.
Yeah. So they were more of a CTA, and it was good because it wasn't like a basic role like getting coffee or something. I had one job at that company, and that was to help him make sense of the COT report. And so I worked on that for a really long time. And basically the goal of it was to, learn how to create a systematic model and, implement it into a live trading environment. And so,
wow, you were, you had a guardian angel looking over you. I mean, compared to like a lot of people, they say, well, I want to learn about trading. They go the internet. You went to a pro, and then you learned and helped him with a valuable tool. What a great start.
Yeah, that was that definitely helped a lot because I mean the internet's good, but you've got to have the
filter.
The sense. Yeah,
you need a filter.
And so, anyways, worked for him. Quickly realized I did like the day-to-day waking up, doing that, and so went back to university, finished my degree, and then the day that I graduated, I opened up my investment firm. It's an RIA. It's a registered investment advisor, and and so I manage money for friends and family. And that was a little over 2 years ago. So I've been doing that for 2 years. And then on the side, basically I maintain a lot of free websites for traders or investors that try to take a complex topic, break it down, and then make it look visually, interesting and actionable. And so the one thing that I focus on a lot is COT, is positioning. And so yeah, that's sort of where I'm at now. Okay,
very good story. And okay, so why don't we get into? You sent me some messages, some DMs yesterday, and you're the boss. I'm just the host. So wherever you want to go, I could follow you, buddy.
Cool. Okay, so the CEOT report, in short, is a weekly report put out by the CFTC that outlines how different types of traders are positioned in the markets. Now, what a lot of people don't know is that there are a lot of different COT reports. So for example, this one is called the Legacy Report. They started releasing the report in 1986, and this was the format they started. And unfortunately, this is the format a lot of traders still use. So it's really basic. It only has two main categories, non-commercial and commercial. So around the mid-2000s, the CFTC got some pressure, and they're like, hey, there's a bunch of different types of traders now. We want more detail. And so they started releasing what's called the disaggregated report. And this is what the disaggregated report looks like for gold. So we got a bunch of different categories, and let me walk you through them. So first over here, we've got producers and users. So, for example, for gold, a producer would be like a gold miner who wants to sell futures to hedge. So let's say that you're a gold miner and you're sitting there, and let's say the price of gold's high, something like $1,700, $1,800 an ounce. And you know that you don't have a lot of gold to sell right now, but 6 months from now, you're going to have production coming online. And you think the price of gold's attractive now, and you want to lock it in. So how do you hedge and lock it in? You sell futures. But on the flip side of that, so that's sort of the producer side of the equation. On the user side of the equation, let's say you're a company like Starbucks or like a coffee manufacturer, and you know that in a couple months you're going to need to get a ton of coffee for your production process. You're going to need to buy it, right? So you're a user. So how you hedge is you buy coffee futures, so that if coffee futures go up 20% in the interim, you've already locked in the lower prices. So that's sort of the hedging side of it whenever people talk about producers and users. But there are a bunch of
that's the whole reason that futures markets were developed.
Exactly.
It wasn't just to gamble and speculate. It had a legitimate economic reason.
Yeah, and it's been interesting to watch that like 20, 30 years ago, when you look at the open interest of these markets, who dominated it were the hedgers in commodities. But as time has progressed and has like commodities as an asset class have got more popular, you've seen speculators sort of be a bigger player. And so that's sort of why I make a point to pay attention to speculator positioning, just because they're a bigger, person in the market. Anyways, though, so we've covered, producers, users. Now we got another category over here called swap dealers. So swap dealers actually can initiate a position for like a bunch of different reasons. It's not so clear cut of who they actually are, because it can sort of change depending on the market. And for that reason, I completely exclude analysis of swap dealers, because it's more opaque. You don't really know what you're looking at. But I definitely do pay attention to the other speculator categories. So we got managed money, other reportables, and non-reportables. So money managers are typical fund traders, be it like a hedge fund, a CTA. Other reportables are other large traders that are trading above the reporting limit for each contract. So they're basically trading large size. And then,
you mean like me?
Exactly, Dale. And so so the last category is non-reportable. So that's small speculators. Those are people trading under the positioning limit. So another thing
is that still, even with the new report, Adam, with the category that you're most looking to fade?
No. So a lot of people say at the beginning, they're like, okay, pay attention to the small speculators. It's the dumb money, fade them. So I've run a lot of analysis on that, and I've found that it's basically a wash. Sometimes they get lucky, and sometimes their positioning's right, and then sometimes they're not. And so I personally really don't pay attention to small speculators. I do look at speculators in the aggregate. And since the money managers and the other reportables tend to, be trading larger size and stuff, they have bigger positions, that sort of dictates spec positioning. And so another thing worth knowing is that with the CEOT report, there's two ways to slice it. So over here with the legacy report, this only covers futures positions. And the disaggregated report, they also offer options and futures. So they convert options positions on like a delta equivalent basis to futures. So all you need to know is it's just a more comprehensive report. You need to look at options positioning too. And so that's sort of an overview of the different types of traders.
All right. Do you get good tells from, I know a lot of option traders look for, size to give them some type of potential market tell for direction by the kind of size coming in. Do you get, and options are like relationships, 90% of them expire worthless. Do you notice that with the option positions that really the goal is for them to expire worthless and they'll pin it near an important strike?
No, I mean, to be honest, you can't really discern that, because the options, it's just all rolled into one number. So you can't really figure out, what's a future position, what's an options position. But the next thing I sort of wanted to talk about is So this is just a current report. So like this is the most recent COT report for gold. And one thing to know is that COT is always as of Tuesday's close, and it's released on Friday. So there is a little bit of lag with it. So you have to be, I don't know, you have to recognize that. But anyways, this is a current report. So you're probably looking at this, and let's look at like gold producers and users right now. So right now they are long 35,000 contracts and they're short 213,000 contracts. So you might look at that at face value and be like, oh my God, you know, they've got a huge, you know, net short position. Well, it's really important to go look at the past for this to see how that position has changed over time. So this is the actual historical file to download. So obviously you look at this, you're like, oh, this makes no sense to me. It's a ton of data. And so here's sort of how I walk through making sense of it. So we got gold, we got, you know, different weeks with the rows, we've got open interest, and then we've got the producer and user long position and short position from that sort of snapshot report I showed you. So the first step to make sense of it is you got to make a net number. So this is sort of just longs minus shorts. But and now a lot of people stop here. A lot of people just look at net positioning, be it for speculators or producers and users. I do not like to do that because think about this. Right now, so producers and users are net short 177,000 contracts. And right now open interest is like 730,000. What if over the past 2 years, open interest has doubled from, let's say, 350,000 to, you know, 700,000? What that means is that a net position of like net short 177,000 would look massive, you know, relative to 3-5 years ago. But since open interest has grown, it's really not that huge of a position now. And so all these futures markets, they both expand and shrink. So some of them, their open interest explodes. Like the biggest examples would be VIX futures right now. And so you can't just compare a net positioning number for VIX futures relative to what it was 5 years ago, because the market's different. It's a much bigger market. Vice versa, some markets shrink, like actually NASDAQ futures and palladium. And so if you're comparing like a net positioning number 3 years ago to now, the market's a lot smaller. And so that position looks bigger than it other would have been. And so
you do need a historical perspective as 3 to 5 years. A good number to go back to. And
well, here's what I do. Yeah. So the first step is you take your net position, and then you need to just scale it by open interest. So you take this number, the net position, and you just divide it by the open interest. And so this is the net producer and user position for gold as a percentage of open interest. And so right now it's negative 24%. But what you need to know is that these numbers can be different extremes in different markets. So for example, right now, you know, gold producers are net short 24% of the OI in gold, but and that actually is sort of extreme. But you could go over to a market like crude oil where that's unheard of. That's a super net short position. And so what's extreme in crude oil might be a totally different figure. And so to sort of normalize positioning between all these contracts, I just create a percentile. And so a percentile takes the current value and looks at its range relative to the past 5 years. So for example, with gold, the 5 year, the most net long gold producers and users have ever been over the past 5 years is a positive 1.8% of the open interest. And that was around right here in like mid 2013. Now, the most net short they've ever been was around negative 30% of the open interest. And that was back over the past 5 years, that was back in like mid or late 2012. So you might notice that you're like, okay, wow, producers and users, they've never really been super net long. They've always really been net short. Why is that? And it's because commercial producers dominate the open interest of the producer and user category. Think about it this way. It's because commodity producers have a lot more risk on the table. So let's say you are a coffee company and you're a user and you need to buy coffee futures to fix the price of your future inventory. If coffee futures go up, or if, you know, a livestock futures go up, a lot of commodity users can pass that price on to the end consumer, right? So that's why, grocery store prices can go up. But if you are a commodity producer, and your livelihood depends on getting a certain price for corn or wheat or gold, you stand to lose a lot more if the price of a commodity drops a lot between now and the time you go to market to sell your inventory. And so knowing that producers have a lot more to lose, you see that producers are the dominant hedgers. And so, anyways, over the past 5 years, that's sort of the range, for gold producers and users. Positive 1%, negative 30%. Okay, so where does this current figure fall? Negative 24%. It falls on the lower end of the range. And so, let me change that up. So like right here, the current percentile is 20%. So that means that if this 5-year positioning percentile is 100%, that would mean that producers and users had never been this, net bullish over the past 5 years. So 100% is an extreme reading on the bullish end. But on the lower end, 0% would mean that producers and users have never been this net short over the past 10 years. And so, for example, right now, if producers and users came in and they got, short negative 30.8% of the open interest, boom, the 5-year percentile goes to 0%. So it's super net short. But right now, it's about 20%. So that's the 5-year percentile. So how I sort of show this is here's that 5-year percentile. It's the green line on my website. So we're looking at gold. We're looking at, net positioning adjusted for open interest. And the green line is producers and users. So what's sort of interesting in gold right now is that gold producers and users are actually more net short now at lower prices than they were last summer when gold was in the mid 1300s. And so that's sort of, an interesting thing. But
how would you interpret that as a bearish signal for gold or what?
So overall, if you take two prices and right now, gold's price is lower, and you're telling me that the people who know the most about that commodity, gold producers and users are more net short now. They want to hedge more now. Obviously, you need to incorporate other stuff, but producer positioning right now in gold does lean, slightly bearish. But let me show you. So now I've sort of outlined, what the CEOT report is, how you need to look at the past, how you need to adjust it for open interest. Let me show you how to actually make it actionable information, because I think a lot of people screw up interpreting CEOT. So a lot of
I also wanted to ask you, Adam, do you find it useful for currencies?
Oh, absolutely. So now some people on the surface will say, hang on, CEOT data only covers futures and options positions on currencies. That's just a drop in the bucket relative to, the gigantic Forex and OTC market. And that's absolutely right. And it is also the same case with, stocks and bonds. But the positioning in those financial futures is representative of sort of the larger, pond. And I've found that CEOT, it honestly works the best, in my opinion, in commodities where it is the primary market, but it definitely is still worth paying attention to in financial futures. Anyways, though, so let me explain sort of how I think about it, how I think about CEOT. So a lot of people just take extreme positioning at face value. So for example, let's look at something like coffee in 2012. So this white line is speculators. So it's that same metric I just walked through, but it sort of aggregates together the money managers, other reportables, non-reportables into one category, takes a net position, adjusts it for OI, and shows you a percentile. So white line, speculators. So in 2012, speculators, like right here, November 2012, speculators were more net short coffee futures than they had ever been over the past 5 years. So I assure you, and I remember back then, a lot of people were writing about it. They were saying, wow, traders are massively short coffee. It's a crowded short position. Fade it. This is going to be a firework when it explodes. And what did coffee end up doing? It kept on going down. And that makes sense, because think about this. So who was in this trade when coffee was going down? A lot of trend followers. Trend followers, price sort of governs what they do. And so if they're short coffee and coffee does nothing but go down, they have no incentive to cover their short. They're making money. And so I think it's really important not to just sort of immediately want to fade extreme spec positioning. Think about it. What's going to cause people to really react? It's when they start to fall under pressure. It's sort of like a fire in the theater situation of crowded, like net short positioning for coffee really didn't matter until coffee caught a huge bid. Okay, so when coffee starts going up.
So it didn't matter for a year, and by then you're broke.
Exactly. And so if you would have solely looked at coffee and said, okay, everybody's short, I'm going to fade it, I'm going to get long. No, quick way to lose money. But if you look at it sort of, you need to take in a second dimension. If you say, okay, positioning super short, but they really don't have an incentive until price starts to put them under pressure, go the other way. I'm going to keep an eye on coffee. And when it starts to, stage a technical breakout, then, that totally could be a big explosive trade to the upside. And that is what happened with coffee. It was a massive rip in early 2014. It's because there was so much money on the short side that it was like a massively lopsided thing. And so that's sort of how I like to think about it. Another good example was palladium. So I don't know if you've traded palladium this year, but palladium has been a massive move this year. And it was all rooted in early to mid 2016. Speculators were really short palladium, but the rally never really got legs until it truly broke out, and it went from $546 to now it's basically $1,000 an ounce. And so this entire rally was sort of rooted in speculators being more net short than they had ever been over the past 5 years. So I think it's really important to pair positioning with technicals. If you have crowded, spec short long positioning, but price has just been dripping down, it's still in a confirmed downtrend, you can't fade that. You can't do that. But if they start to diverge, then you've got something. And
so
now,
it puts it on the radar screen, but again, price action is king.
Exactly. And so I will say this though, CEOT is a good shortcut to it's sort of two things. It's a good shortcut that maybe prevents you from getting into a crowded boat. So for example, let me scroll. Let's see what's a crowded trade right now. Something like heating oil, to be honest. Okay, so heating oil and a lot of the petroleum products have been doing well, but heating oil is a very crowded trade that not a lot of people are talking about. So speculators are extremely net long. Okay, so the last time there were this net long was in early 2017, and you can see that price sort of stalled out around there. So what I'm getting at is CEOT is effective for two things. What if I was running a strategy and it called for me going long heating oil? Well, I could sort of gut check the CEOT position and say, oh wow, everybody's long right now. Maybe I want to trade smaller size with this, or maybe I just don't want to take that long trade at all. So it's a good sort of gut check for avoiding crowded positioning. But then secondly, like I said, with the sort of the other side, the fading crowded positioning, it works really well to identify when something could be a massive rip in the other direction. The best example of that I've seen probably this year was orange juice. So going into the hurricane season, speculators were more net short than they had ever been over 5 years. What do we have? We had huge scares about, the Florida crop. And so, orange juice were up 30–40%. And so that was a perfect example of sort of crowded speculator positioning being the kindling, and then price going the other way being the fire that sort of, lit it. And
Great metaphor.
Yeah. And so overall, now you're probably scrolling through all this and you're like, okay, this is a ton of data. Let's sort of make it concise. So what I did is on my website, I just have a dashboard page. And what it is remember when I sort of talked about that 5-year percentile metric, for the different trader categories, this shows you that number for all the markets for the different categories. So for example, this graph shows you, the 5-year net percentile for speculators in commodities. So remember, 100% super net long, 0% super net short. And then I'll also do that for speculators in financial futures, commodity hedgers. And so right now with speculators, here's sort of an overview. So they're super long livestock, like feeder cattle, live cattle, like I showed you, heating oil. And also really long copper, palladium. But on the short side, they're really short soft commodities, so like sugar
coffee.
Yeah, a little bit of the agriculturals like corn and wheat too. So that's sort of commodities. Let's look at financial futures. So what's positioning like? All right, so we are super long Euro US dollar, the Nikkei, Dow Jones, Canadian US dollar. There's not a ton of contracts that are short, but they're really short Swiss franc against the dollar, the yen against the dollar, and the euro dollar, actually, like the bond contract, not the currency. And so so an overview of this is it's no new information to you. It's it's still people betting on a weaker dollar.
I like the way you present it though. It's nice.
Yeah,
really nice job.
Yeah, and then finally with hedgers, which sort of like the smart money and commodity markets, think about it, it's going to be the inverse of spec positioning. So what are hedgers super long? And remember, hedgers being long implies that not a lot of producers are selling because they don't want to lock in current prices because prices are low, but you do have a ton of users buying because they're like, oh, prices are low, I want to fix the cost of my future inventory at these currently low levels. So right now, commodity hedgers, they're really net long in the soft commodities like coffee, sugar, and also the agriculturals like wheat and corn. And so it's sort of the inverse of spec positioning, but that's sort of an overview, and that's sort of how I make sense of the COT. So what questions do you have for me?
Okay, well, my partner Steve Volge has one for you. Go ahead, Steve.
Hey, Adam. Good afternoon. I have a question for you. Is it actionable, is it usable for you to take the difference between the positioning of speculators and commercials? Because I see you showing the percentiles for each category, but I'm wondering if extreme divergence between the two, because I saw in some of the charts you presented before, I mean, they might have the differences between them might have been on occasion like smaller or bigger. Does that produce an actionable signal on occasion?
Yeah, so I've looked into that, and remember, the only thing that would cause sort of a gap, so what would make this a perfectly inverse sort of two graphs is if I included analysis of swap dealers in either category. And that's solely the difference. That's the difference between the two. And so if you want to sort of isolate the difference between, spec and producer positioning, swap dealers would do it. And like I said, swaps, they're not a reliable trader category in that, as producers and users, you always know those are, people with an actual interest in the underlying commodity. And on the flip side, speculators are always sort of trading on their own behalf. But with swap dealers, you never really know. And so I've sort of examined it, looking at the divergence between the two, and there's not a lot of noise in that signal. But here's one thing I will talk about is so these markets are different in sort of the makeup. So let me give you an example. With like natural gas, that market is dominated by speculators. They're like more than 80% of the open interest. But a smaller market like oats is, and nobody trades that stuff, but a smaller market like oats is dominated by producers because you don't hear about a lot of speculators trading oats, and also you can't trade a lot of size in that market, so it discourages like hedge funds. And so, but here's what I'm getting at is I've noticed that with these smaller markets that are dominated by the producers and users, COT report tends to give really useful signals in these less liquid markets. So for example, earlier this year, speculators were super net long oat futures, and then on the flip side of the trade, producers were happily hedging. So every time a spec was bidding it up, oat producers were saying, give more to me. I would love to fix, the price for my current crop at current prices. And so all I'm saying is that when a market is more controlled by the producers and users, I've found the positioning to be less noisy and less sort of a whipsaw type thing. But when you're talking about, so when you're talking about markets like, I'm trying to think, like natural gas, crude oil, gold, all these, honestly, those are spec dominated markets. You just got to be careful, because if you're looking at, so for example, if you're looking at producer and user position in nat gas, you sort of at first glance are like, okay, I'm paying attention to the smart money, and you are to a degree. But if the smart money is only a fraction of the open interest, they're not the people controlling that market, and so it's important to sort of to know that.
Yes.
What a great interview. What a great interview. And oats are a very good technical market. As a commodity broker, I used to love to trade oats. Adam, I've never seen a better explanation and detail on COT before. And I really appreciate you coming in today. We're getting, the best way to follow Adam is his Twitter handle is @MovementCapital. Is that also the name of your website?
Yeah, let me pull it up. So I think right here, okay, so this is my Twitter, and like throughout the week I'll tweet out like some of these positioning charts. And so that's my Twitter, and then my website is movement.capital, and I've also got a bunch of other free tools that people can use. So that's me.
And I see that, like seasonality.
Yeah.
Is that kind of like Jake Bernstein stuff? But are you a big believer in seasonality?
So I think that no, I'm not the type of person to put on a trade, June 14th every year because it's worked the past 7 years. I think that I think it is important to remain cognizant of. And so how I show seasonality is simple 5, 10, 20-year averages, average monthly performance, and I also like to look at term structure. And so I've got that's free too. But no, Dale, I really enjoyed it. I'm happy to answer any questions if people email me or whatever. And so I appreciate the opportunity.
Yeah, well, I'm glad that you accepted my invitation, and great work. And it was great to hear your story. And you're very fortunate to end up right out of college, right out the gate. Like a horse, getting right on the track and providing a great service to traders. So congratulations to you, Adam.
Well, thanks a ton. I appreciate it. And you have a good rest of the day.
All right, partner. There's my trading warrior brother, Adam, and you can follow him @Movement Capital. And that's going to be a wrap for us, guys. I'm glad you enjoyed it, Alina. Good question, Steve Volge. Blake, thank you. Stelios, thank you. Don't just count your pips, count your blessings. And I'll see everyone for What the Heck Wednesday tomorrow. Adios, my trading warrior brothers and sisters. See you tomorrow. You're very welcome, Durin.